We'll get those. Yeah, that's the number.
It's about a third of a percent higher. Those are the rates, the first rates which are coming through. 88, 89 points. The Nifty Bank is down about, is up about 0.4%, 55,267. The mid-cap index is up 0.5. The small-cap index is coming up with a higher rate as well. So this is a decent start, almost at 24,600 at this point in time. Market breadth on the Nifty 50 pack heat map perhaps gives you a sense of where we are starting before we dive straight into individual names. Almost a 100-point pop and 300-point pop on Nifty Sensex respectively. It's all in the green, except three names which are starting lower. Apollo, Hindalco, Power Grid are some of the large cap names. And there are three, Tech Mahindra, Axis and Titan, which are in the red. Prima.
By the way, before we get to the large cap action, three mid caps. One is Yatra. Another 5% up move on Yatra Online. This week, the stock is up 50%. So continues to raise post its numbers. Honasa and Nykaa, the two stocks. Honasa now up 10%, Nykaa up nearly 5%. Getting to the large cap action, well, it's earnings reactions playing out. So Apollo Hospitals is your top gainer, so that's up nearly 4.5%. ONGC has a positive tick to begin trade with. And we should get Hindalco. Came out with numbers towards the close of markets yesterday, and that too has started off trade on a positive note. Power Grid, BEL, Tata Motors, Adani Enterprises, these are some of the gainers in today's trade. On the way down, not too many. You've got a Tech Mahindra, but that was a star yesterday, up 2%, so retreating a bit. Axis Bank, Wipro on the flatter side. All in all, it's 100 points up now on the Nifty. Nifty once again trying to get towards that 24,600 mark. Sensex is open with a gain of about 300 points. Mid-caps are outperforming.
Well, that's right, but plenty of stocks actually doing well. Honasa, as you pointed out, Nykaa is flying away. Senco as well is up close to around 4 to around 10%. All these stocks doing very, very well. Paytm, that's up 3.5%. You know, that sentiment positive that's coming from them. JM Financial, yesterday intraday the stocks did see some profit taking, but that's done well yet again. So big up move is what we're seeing on that particular name. On the flip side, you have Jupiter Wagons, that's under some pressure. That's down close to around 3.5% or thereabouts. We'll be joined by the management shortly, to detail those numbers. Anthony Waste Handling, that's another stock that's popped up in trade. It's up close to around 7.5%. So massive move is what we're seeing out there. Big move on decent volumes as well. And, I think Dream Folks, that one has been, locked in upper circuit for the last few trading sessions. So that's doing quite well. What's not doing too well, I think one stock that I'm looking at is Aarti Pharma. That one is down close to 9%. So slam dunk on that one. Rupa as well is down decent volumes, 1.5 lakh shares already traded. That's down close to around 8%. Both those two have come in for some profit taking. So keep an eye out on those names as well. But it's a good start to trade, guys. Sustaining this opening gap up is going to be very, very important from the bulls' perspective.
Okay, all right. Let's just look at the first rates, which are sort of settling down. It's a triple-digit gain, 24,590 on the index. And you've got the mid-cap index and the small-cap indices, etc., which are going to come up on your screens as well. What do we have, apart from what we've kind of mentioned? I think Alchem is recovering a little bit. Alchem was a big casual, I think it was about 6% yesterday, Alchem. So from a close of about 4,800, it left yesterday at 5,150, and it's at about 53. The high today, by the way, has been about almost 5,400. So it's following through. Transrail is up about 3%, and it's got large size volumes at this point in time. I mentioned Shakti Pumps back at almost 900 rupees. I think the high was 899 today. It's cooled off a little bit, but still 4% on it. Premier Explosives, I don't know if you mentioned it, 11%, 12% on Premier Explosives. Very large-sized volumes at this point. So 476 on Premier Explosives. Look at, there you go, and 30,000 shares as well. Look at Techno Electric, 8% move on Techno Electric, 1,410. Stocks at about 1,473. So it's a pretty large-sized move coming through there. And you could look at a few other names, but volumes start to thin out. This is pretty much the biggest volume-led pack out there. Suzlon is down 3%, and we just had the management with us. Suzlon is the #1 volume-led loser coming through on the NSE. 21 million shares, 22 million shares from on Suzlon at this stage. Sonata Software was a huge volume-led gainer yesterday by close. It's seeing some profit booking. There was no news really on the, in terms of what led to the big move, but it's down 2% as we start this particular session. All right, let's welcome in Manish Gunmani, who's with us. He's a market master of the day, head of equity at Bandhan Asset Management Company. Manish, good morning. Great to have you with us here. Thank you for joining us. One viewpoint is that since late October last year, the market here, you look at MSCI India, for example, it's underperformed MSCI World by about 20% dollar terms. So one view is that, you're going to come to a point where some of this underperformance is going to give us a bit of a fillip, a bit of a spring when market starts to move higher. But you need some triggers, right, for that to happen. What are those going to be, according to you, Manish, as you look ahead?
So if I think about globally, I guess the biggest trigger can, of course, be a renewed weakness in dollar. The dollar's been consolidating post the 10% fall we saw over the last 4-5 months. And I guess part of the reasons emerging markets are doing well is the dollar looks weak, while it's not fallen recently, but it does seem to have its challenges fundamentally. On the domestic side, I think last 12 months have seen a slowdown in the economy versus expectations. And I think what can probably turn this around, hopefully, is falling interest rates, tax cuts playing through, maybe pay commission in a few quarters. So we're quite hopeful that the slowdown that we've seen over the last 12 months will get reversed in a sense over the next 2-3 quarters. So I think once you start seeing some traction in nominal GDP, I think India has seen a fairly decent fall in nominal GDP coming down to single digits. I think it's important to get it back to
Oops.
I think we lost the line there.
monetary side, we've seen similar, right? So on the monetary side, we've seen significant stimulus. So we are hopeful that once we see the nominal GDP come back, the outlook on earnings will improve, and we should then see the market resume its uptrend.
India has greatly underperformed the MSCI emerging markets, right, in the last 1 year. Now you're saying that things will improve from here on. What would you bet on? What would be the extent of the improvement? For instance, we were just, reading out a call from Mahesh Nandurkar from Jefferies, and he believes that we will see a bounce, again, for the same reasons that you articulated, but the bounce may not sustain for long due to weak value versus growth equation and equity supply concerns. Now, in the last 1 year, Manish, we've already seen no return for the Indian equity markets.
So I think we should not be focused just on last 2-3 quarters. If you see on a 3-5 year basis, Indian markets have healthily outperformed emerging markets. And once that extent of outperformance happens, there'll be phases where mean reversion happens. So today, obviously, China, Korea, Taiwan, they probably got very cheap at the end of last calendar year. And this year, they will outperform, I guess, just by mean reversion. I think India remains a bit of an insulated story in the sense that, look, foreign investors don't play India to play US consumer or something like that, right? Or US tech, for example. We are a steadily growing, primarily domestic economy. To be fair, we have, as I said, undershot our expected growth over the last 12 to 15 months. I do hope that given the monetary stimulus, and I would think that even fiscal stimulus should start picking up. I think the kind of CPI number we saw yesterday, for example, just shows how much space we have in terms of the macro stability has gone to an extent where I think it's given you a lot of space to stimulate the economy. And I hope we see some strong policy action as a mix of fiscal and monetary, because we definitely, I think, should be, as a country, aiming for double-digit nominal GDP growth. And given that our current account is in a brilliant shape, inflation is in brilliant shape, there's not excess leverage in banking or household sector. I think there is a lot of space to stimulate this economy and get growth back.
Hi, Manish. Good to see you. Where do you generate alpha, though, in this sort of market? In the past, you've spoken about a couple of sectors. I recall towards the end of last calendar year, you were talking about metals, oil and gas as well. Those could be themes that actually you could make better returns. Do you stick to that? Or do you think that, things have changed? In the metal space itself, if China is going to recover, since there are regulators that are peppering the economy, maybe it could be better times. What's your gut on it?
Yeah, I think metals worth a risk reward trade. See, metals is not a buy and hold sector, but given the expectation we have at least of medium term dollar being weak and China probably bottoming out, and the fact that it just bottom up when you see the cost of extracting and producing these metals versus the current market price, a lot of these industrial metals are definitely cheap. So I think metals is a good risk reward sector. I think consumption at the mass level, um, while it may not be a very structural buy and hold story, but uh, given this phase of last 3-4 years where a lot of consumption stocks have been flattish, I think, as I mentioned last time, there are a lot of brand companies which are available at 1 to 3 time kind of sales. Typically in India, those are very good entry points for consumption stories. And while when you play a cycle, nothing is clear when it will play out. So you can't be 100% sure of a strong consumption cycle coming through. But I think the risk reward is good. I think as I said, the valuations are cheap, expectations are low. So I think with a view of 12 to 18 months, because pay commission may come by that time, um, I think these consumption stocks which are cheap, I think that is a good theme. Structurally, I think the theme remains technology, the internet platforms. Those I think are good buy and hold stories, uh, or any company which can produce medium to high end products and services and export to the world, because there is a shortage of trained manpower globally. So whether it's engineering, pharma, if you can find a company which has got good R&D, has products with moat, and which can go global with those products and services, I think that those are two structural themes, I think, which we continue to believe in.
What about cement, Manish? In Q1, we saw good improvement in the realization across in the industry. Do you see competition being rational, and from here on, the EBITDA per ton improving or sustaining? And how is cement looking for you? Looking to you?
Personally, I'm not very hot in cement. I see cement as a trading sector because the penetration in India is very high. Uh, while it is consolidating a bit, it is not a sector with very secular pricing power to my mind. So you have to buy when things are down and you sell when things are good. Today, I think a lot of market participants are very bullish on cement. Valuations are high. Stocks have done well. So not a sector I would be very hot on at this point of time.
Okay, all right, Manish, very quickly, what about defense? It's got a longer runway and there's going to be plenty of focus both in India and globally, but valuations became too expensive. Some of them have corrected. What's your view?
Yeah, to be honest, we've not played this theme very aggressively. The macro has been always attractive in the sense that not only in India, but globally also, particularly in Europe, you're seeing defense budgets shoot up. If you see defense stocks globally have done well. But the point, what concerns us is just it's a one client sector. And the kind of margins we are seeing defense companies make, they are a bit surprising because they've gone up a lot. And of course, the P multiples, even on those higher margins, are very high. So it's not a sector I would be massively bullish on, to be honest.
Look at Aarti Pharma. I don't know if you've highlighted this, right? It's a large cut, 8.5% cut. So just pull the stock up, 784 on very large volumes, by the way, coming through. Coromandel is another one which is around about 4% or so. So that's a large cut, 4% loss there. And by the way, these are all within the top 5 volume-led losers list. Vari started slow. It started actually almost flat, but Vari is now number 2 volume-led gainer, 3% lower on Vari. And of course, we highlighted Suzlon, which is down almost 4.5% at this stage. So stuff is moving on both sides. Although with about 15 minutes of trade behind us, it's clearly advantage gainers over decline. 70 points on the Nifty is what you have. Manish, thank you very much for joining us. Great speaking with you here on CNBC-TV18. Really appreciate it, as always. Nigel, but I think we have the management of BEML with us.
Well, that's right. Let's focus on BEML. The start to the year was actually muted, but what's the way ahead? We're joined by Mr. Shantanu Roy, the chairman and managing director of BEML. Hi, Mr. Roy. Good morning. Good to see you. And as always, well, the start to the year has been a little bit muted. So I wanted to ask you whether you want to revise any of the big 3 numbers you gave us last time around. You were talking about revenue growth of around 20%. For the start, it's been flattish. You were talking about margins improving by around 150 basis points. And the order book ending at around 22,000 crores for the year. All these 3 numbers do hold out?
Hi, Nigel. Good morning. Thank you for having me here. All the 3 numbers, it should remain the same. The 20% growth, the margins, as well as the order book. The order book has done pretty well. In the current financial year, we have already received orders of more than 2,900 crores, out of which 60% has come from rail, metro, 20% each from mining and defense. We are at an all-time high as far as order book is concerned, 16,673 crores of orders, out of which rail, metro makes up 65% of the order book, 26% is defense, and 9% is mining. So we have held on to the numbers in the first quarter. There have been some pluses, some gains, especially in terms of the margins getting better. Number 2 is the cost going down. We have held on to our employee remuneration. We have held on. We have reduced the inventory. This year, our major focus is on reducing the working capital, and for that, reduction in inventory, reduction in the debtors.
Mr. Roy, just to comment out there, actually the start of the year has been very, very feeble. There's not been any growth. But just to reiterate, you're saying that the remaining quarters onwards will be good, such that you achieve a 20% growth, right?
Yeah.
And because of the cost focus measures as well as operating leverage that will play out, margins this year will improve by around 150 basis points in comparison to last.
Yeah.
And order book goes to around 22,000 crores. That's right? Any particular reason why the last quarter then was flattish? Are you having some supply issues? Is there, any kind of difficulty you all experienced in the first quarter that it was so soft?
You see, there are 4 critical pillars for any organization to perform. First is the design, second is the supply chain, third is the capacity or capability in terms of human resource, and the plant and machinery. So here the material, that is the supply chain, has been of major concern to us. The supply chain is taking more time to stabilize than what we expected, especially for rail and metro, especially for the defense. And more so because we are indigenizing, and in the process, in our journey of indigenization, the supply chain has to not only be able to give the numbers, but also they are to come up and give the quality that is desired. So these 2 areas, the supply chain partners, the industry partners, have to ramp up. And that is where it is taking some more time to stabilize. In spite of that, it's a commendable effort, I should say, that we have held on to the numbers. But the second quarter onwards, and more so from the third quarter, when we expect the supply chain to further stabilize, and with more options coming our way, especially in the rail and metro, especially in the defense, in terms of the industry partners, the number of industry partners who will be onboarded by that time and who will be developed by that time. So things should go well. So this year, majorly, it is an execution challenge.
Okay, so that explains the
Orders will come, but execution is the main challenge.
Okay, and is that what explains even the Q1 softness, the execution?
Absolutely.
Got that. I think last time you spoke about one large Mumbai tender, which you were hoping to close, about 30,000 crore. Is that correct? Which you were hopeful will close soon.
The tender,
it was a Mumbai MRVC train contract, about estimated, I think, 30,000 crore. You said expected to be floated soon, but likely execution will start only next year. Has that closed? What's happened on that front?
The MRVC tender is yet to be announced and yet to be floated. And once it is floated, it will take at least 6 to 8 months for the conclusion to be reached. And the execution will start 2 years, at least 2 years. It's a huge number. It's 2,856 cars to be precise. And it will be executed over at least 5 years. And the execution will start only after 2 years. But in our estimates, we have not considered the MRVC for the current year.
Okay. And exports, what was the contribution, Mr. Roy, of exports in the current quarter, and how will it trend going ahead in FY26?
Current quarter exports has not been very good, but in the second quarter, the exports contribution is going to go up to at least 3 to 4%. We are in the process of executing one big order from the CIS region. We expect some more orders. I'm talking about the mining and construction vertical. We expect some more orders which we'll be executing in the current financial year. We expect some orders for the rolling stock in exports for the first time. The order that we have recently received is only for the retrofitment and upgradation. But the new rolling stock order, we should expect some rolling stock orders in the export market in the current financial year, which will then go for execution in the next financial year.
Okay. What about the Vande Bharat order, sir?
Vande Bharat, already the order is there. We are in the process of executing. Okay. And very shortly, the second, third, fourth rakes will come out. And the balance 6 rakes also, in the coming 4 to 5 months, we will be completing that order.
So what is the contribution to the revenue, sir, in this year? Please go ahead.
The contribution of Vande Bharat to the revenue this year should be around 10%. Into 10%.
Got it. All right. So just want to clear out 2 numbers. One is on exports as a percentage of your mix in this 20% growth, that you're talking about. How much will exports stabilize at for the fiscal? And defense as well, you were guiding that, it will contribute more in this year. Yes. So as a percentage of the mix, what will it be?
You see, last year, defense contributed around 27%. This year, we are expecting defense to grow by at least 70 to 80%. That is what we are looking at, and we have the orders also. So contribution of defense should cross 30% this year. That is number one. As far as exports is concerned, the overall export, the physical export that we expect this year to the top line should be around 3 to 4%.
Okay. All right. Well, it's always a pleasure having you on the show, Mr. Roy. We're going to hold you to these numbers, but you're saying there were some supply issues in the first quarter. You're optimistic things recover from here on, and the 3 big numbers you're giving us: 20% growth, 150 basis points improvement in margins, and order book to around 22,000 crores. Thanks a lot for joining in here on CNBC-TV18. The stock as well is perking up a little bit post that positive commentary.
Okay. By the way, for the markets, it's holding on to gains, about 0.25% higher on the Nifty, not 100 points up now, but about 80 points up. It's 24,568. Some of the gainers include NMDC Steel, Honasa now 12.5% higher. Apollo Hospitals, 6% surge seen in Apollo Hospitals post the numbers. Paytm is moving up smartly, 5%. Shakti Pumps also higher. In fact, let's talk about Apollo Hospitals reacting to a strong set of Q1 numbers, healthy revenue growth, margin expansion. Sunita Reddy, Managing Director at Apollo Hospitals, is now with us on the show. Thank you very much, ma'am, for joining in. Strong performance in Q1, 15% revenue growth, EBITDA margins 14.6. Give us an overview what led to the growth in the current quarter and what would the guidance be for FY26? I think you're targeting a double-digit revenue growth. What will drive that?
So we grew 15% consolidated revenue. Numbers came in at 5,842 crores. But more importantly, EBITDA grew to 845 crores. So there's a significant improvement of 26%. And PAT at 433 crores, improvement of 42%. So headline numbers look good. More importantly, I think, the revenue has translated into profitability, into EBITDA. In the healthcare services business, there was 11% growth with 2,935 crores of revenue, representing 11% growth. EBITDA grew by 17% to 718 crores, and profits came in at 384 crores, representing an 18% growth in profits. So more importantly, healthcare margins were strong at 24.3%, representing an 83 basis points improvement over last year. Apollo Health and Diagnostics showed a healthy growth of 19% with the revenue of 430 crores, EBITDA at 40 crores, and a slightly negative PAT of 8 crores. But moving forward, I think, Apollo has established a primary care platform, a secondary, tertiary, as well as a great funnel for patients, an ecosystem for patients to move through the system using digital, which is our 24/7 app.
Ma'am, good morning. Prashant here. Strong numbers, and I think the market is responding to that. Was you said healthcare services revenue, that's hospital revenue, went up 11%, right?
Yes, yes.
Whereas the AHLL and the Healthco are the ones which really led growth, 19-20% growth there. Was the hospital revenue growth at 11% a little softer than what you expected? And what can we expect here?
Yes, I think definitely it was a little bit softer than we expected. In terms of, moving forward, I expected to get back to 68%, 70%. And with that, the 14% improvement in revenue over the rest of the year. With this, we did have an impact of Bangladesh, where that impact is being mitigated in the second quarter. We found more patients, international patients, entering the system through the offices we've opened internationally. So, however, our payer mix continues to be strong, which is why our EBITDA is at 24.3%, and I think that is a very important factor. Insurance, private insurance. Go ahead.
Yeah. You're saying international patients will pick up substantially.
Yes.
What is that as a share now, ma'am?
Currently, it's about 5% of revenue. It was 7% of revenue, but in the North Indian destinations, it is picking up. In our hospitals in the north, in Karnataka and Hyderabad, we're seeing a significant uplift. Chennai is starting to see international patients once again.
So you'd go back to 7% as a share?
Yes, we should.
By when, ma'am?
By the end of this year, we should be able to achieve 7%, moving towards 10% next year.
Right. So again, just to focus on the hospital business, inpatient and outpatient volumes were also maybe a little softer than what you thought, right? 3% and 9% respectively.
Yes, I think, you're right. The focus this year was on improving case mix, which is revenue from cardiology, oncology, orthopedics, gastroenterology, and this played out very well. We had an 8% increase in high-end tertiary care, which resulted in a 9% improvement in ARPP, which came in at 1 1,72,000 rupees.
Right. Got that. Could you give us a sense on the bed addition plans for the full for the full year, ma'am? Where do we stand?
Yes. Currently, we're opening Pune with 250 beds by the third quarter. We're opening Defence Colony this quarter with 87 beds. Defence Colony is a fully focused women's healthcare, including on-call unit. We have Sonapur in Calcutta with 250 beds, as well as Belapur. So Belapur is an acquisition, Belenis Hospital, which is an acquisition in Bangalore with 150 beds. So these are the 4 hospitals that we will be opening in the third and fourth quarter of the year.
So in total, what are we looking at in terms of addition?
In terms of addition, we're looking at 500 beds added this year.
Okay.
Okay. Ma'am, you also announced the demerger of the omni-channel pharmacy Digital Health 24/7 into the new entity Apollo Health Tech. It's a move to unlock value for your shareholders. What's the status of the demerger right now?
It's been approved by the board. I think we've made the application to CCI and NCLT. This should take about 18 months. In about 18 months, we should be ready to announce, and following that AGM approval, we should be able to list.
Got that. But 18 months from here on, in terms of a timeline for listing.
Yes.
Okay. I know we've asked you this when, the plan was formulated about the Apollo Health Tech guidance, 25,000 crore of a top line, 7% margins by FY27. Now, I mean, even since then, the street is still a bit circumspect on how you're going to get to these numbers. I mean, can you tell us how it's changed? What's changed in the last 3 months that makes you even more confident or equally confident?
No, I'm very confident because even if you look at the numbers, there was 2,747 crores of revenue from both online and offline. And in this, the most important 19% growth. EBITDA, however, grew more strongly at 25%. And this came in at 97 crores. Profits grew to 57 crores. So as I guide for the future, I think the change that's going to happen is with the integration of KeyMed, the back-end pharmacy. So you're already looking at a huge potential for almost doubling growth. And over a 3-year period with the integration, they should reach revenues of 25,000 crores. And currently, the offline margins are at 7.7%. Holistic margins for online and offline are at 3.8%. So they're also showing a margin improvement. If you look at the different lines of business, 4 lines of business, unit economics are good. All of them are profitable. So if you add to this the addition of the back end, I think, it is not only a growth at scale, but it's profitable growth.
We're also seeing competition rev up in the entire sector. Manipal acquired Sayadri Hotels for about 6,000 crores. They're adding 11 hospitals. I mean, give us the competitive landscape right now from organized players. There is PE backing large hospitals and large chains. Your own thoughts and what are you planning? Are you looking at any acquisitions?
We continue to look at acquisitions. Let me just put this one figure before you. Of the 16 lakh beds in the private sector, 1 lakh are totally private, held by trusts, etc. They are only less than 50,000 corporate beds. So there is a huge structural demand-supply gap. And I think that corporate has done very well in lifting clinical quality. More importantly, if you look at our average revenue per patient, which is 1.72, it's 1.72 lakhs. It's now, we're accessible to insurance. So insurance has grown by 30%. Corporate hospitals, patients can access corporate hospitals. So therefore, we believe that the demand is strong. Patients have access to private health insurance, and it will continue to grow. So consolidation is one way of growth. In Apollo, we believe both in acquisitions, brownfield growth as well as green.
All right, we'll leave it there, ma'am. Thank you very much for joining us. Good speaking with you, and I really appreciate your time here. Stock surging 6% the last I checked, and these are on the back of a very strong EBITDA beat which has come through. 7,700. The share of international patients is going to rise. It's at about 5% now. It used to be 7%. They're hopeful it'll go back to 7% by the end of this year. That's the guidance coming in from Apollo. We'll take a break. We are back. We stick with broadly the pharma healthcare space. Granules India will be with us to talk about their first quarter performance. Stay tuned.
Welcome back. Let's talk about Granules India. Subdued quarterly performance, top line growth only at 2.6%. Profits are down 16%. We have with us Krishna Prasad, Chairman and Managing Director at Granules India. Thank you very much for joining in. Can you tell us the 2 to 3 reasons for the weakness in Q1? It's just a modest 2.5% revenue growth. I mean, what were the pressure points in the current quarter? And 2, are you seeing a recovery Q2, Q3, looking ahead? And can you maintain margins at 20% plus?
Yeah, good morning. The main reasons for subdued performance or flattish performance for Q1 was, compared to Q4, was a capacity constraint. We are having a remediation going on in our Gagillapur facility. And actually, the production has come down by 10 to 15%. And the main problem is only supply. We have now our GLS plant, a new plant with 10 billion dosage capacity, inspected by the FDA, and we expect approval in a month or 2. And once we get that, we expect that we will be overcoming the supply issues. And also, Gagillapur facility, which is under remediation, we are planning to go back to the FDA shortly, and then we expect that that also should be cleared by December, Q3. And Q4 onwards, we are very confident we'll see an increased performance.
Okay. So at least half of Q2 is going to be impacted by capacity constraints because Gagillapur still stays as is with production down 10%. And even the new facility you said comes up only in the second half of Q2. And can it ramp up immediately? How much of the shortfall in capacity can it make up?
So we do have a good order book position, and I think we can definitely do good with another 20%, 25% capacity. We should be able to easily sell. And all that is holding us back on the new facility is the FDA approval. We have filed, they did a pre-approval inspection, and we're just waiting to hear from them. There's no issue. The inspection went very well.
Okay, so as soon as you hear from them, I mean, it comes back up and the supply problems go away.
That's right.
The hope. Okay. Now, margins at 20% have been maintained despite these remediation costs, integration of Sen chemicals. Can you guide us on margins as well? Where do they head from here?
Margins will definitely, if you see our gross margin, it's been actually increasing, and only the increase in revenue is going to contribute to a very healthy margin. I cannot tell you numbers, but definitely there'll be a very good uptake in margins once the revenue increases.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. What can you guide us, though, in terms of a revenue growth for the year? The start has been in low single digits. What should we work with?
I think quarter on quarter we'll definitely see an improvement. And the whole year, I'm sure that we will see at least 15% improvement over the last year.
13% improvement. Got it. What about, what is it?
13 to 15% for this year.
Okay.
And next year, when with full capacity, I think we will see a very good takeoff.
So 13 to 15% this year, and next year, given that you'll have full, capacity on stream and available, what should we work with? What is the aspiration?
Let's get to that. Definitely, the aspiration is high. And yes, maybe we can talk about it in the last quarter of this year.
You led me to it, so I thought maybe you want to give me a number. But that said, you are facing some headwinds in the paracetamol API segment. Have things normalized there? Demand is okay. Are you seeing an uptick now?
The demand has improved a little bit. There's small uptick, but definitely not to the old levels. I think it's not going to greatly improve. There's a lot of capacity in the world today. People have increased capacities in India and China. And we actually have concentrated on more of PFIs and finished dosage of paracetamol. That's what keeps us going. But otherwise, APIs are not in great shape.
What is the revenue contribution purely of paracetamol API?
Oh, that'll hardly be about 10%. It's more from PFIs and FDs.
Got that. But this 10% is headwinded on account of excess capacity in the world. US was up about 7%, and that, I believe, is the company's largest market?
That's right.
Okay. So, what are you projecting from in terms of growth or numbers from the US? And considering this, the expectation on tariffs on pharma under the Trump administration, your own view?
It's going to be, US, we do expect a good growth. But the tariff situation is a little unpredictable as of today. We don't know what's going to happen. However, the confidence we have is we are in generic market. The margins are at the lowest. And the competition, it's a level playing field for all companies. If today, if we have a market share, good market share, with the extra duty, which is equal for everybody, we don't see a dip in the market share. And also the customers have been very understanding, and definitely we are having talks with them, and we definitely are sure that we should be able to pass on the increases to the customers.
This is not so much a question with regards to granules, but if there are, farmers right now exempt, but there are these investigations under Section 232, which apparently are going on. At some point, we'll hear. What is the, what's the increase in cost that you will have to take? And, even with those increase in costs, what are the difference? Is it a factor of 10 as compared to what you make when you make in the US as compared to what you make from here and then export out? Could you give us a sense?
If you make in the US, it's not a factor of 10%. I would say.
Not 10%. A factor of 10. Not 10%. So is it would a 10-15% kind of tariff derail, businesses like you who sell into the US at all? Or no, it'll be a minor speed bump?
For normal generic products, even at 25% rate of duty will not justify manufacturing in the US as of now. But for certain type of products, we have a manufacturing plant there. About 20% of our revenue comes from US manufactured products. And there we have a healthy margin because the type of products are different. It's mostly in the CNS and ADHD space. But normal generics still doesn't make sense to produce in the US.
And that's unlikely that is the attempt as well, right? Because, I mean, generally the conversation there has been to lower cost of drugs for Americans. Would you imagine that that's something which comes under, were they trying to do something there on generics?
Whatever the attempt is or whatever comes out, duties are only going to impact the American public, and the cost of healthcare in the US is going to go up.
Yeah, eventually the consumer is to pay. Thank you very much for joining us. Good speaking with you. Good luck with the business as you look ahead. So that is the overall picture as far as Granules is concerned. A bit about the overall environment as well. Mitesh is back with us with what she'd want you to do in terms of specific trades. We're up 114%, 24,600 holding. Mitesh, what would one do?
As of now, today looks like a day on the positive side. On the index, as I said, I think we might head towards 24,750. Right now, I have one buy and one sell recommendation. On the selling side is Oil India with a stop at about 420. Look for targets of roughly around 400 on the downside over here. And metals are doing very well. So I have JSL as a buy call. Keep a stop at 712. Look for targets of 760.
Okay, all right. Thanks a lot for that, Mitesh. Well, in fact, yesterday we had mentioned as well in our morning chat that metals could be the space to look out for because there's some recovery in China, as well as we're seeing some weakness on the dollar index. And now the street is waiting by for some rate cuts as well. But talking about metals, we'll slip into a short break. Manisha is waiting for us on the other side. She'll tell us what's going on in the commodity space.
Okay, welcome back. 100 points on the Nifty, 24,600 still holding. Let's focus on some stocks which are moving. Honasa is up 10% in trade. Mangalam is here to revisit. He told you about the name right before we open, sticking on to gains. Mangalam.
It is sticking on to gains, and the street expects it to continue to stick on to gains because, despite, there being a weakness in terms of their summer portfolio, the revenues of the company grew 7.5%, which is higher than the industry on a low base. Obviously, the EBITDA did not decline as much as the street was fearing. Brokerages were expecting around a 20-25% decline in the overall EBITDA, but here the EBITDA decline was contained to just about a 1% mark. Ad spends as a percentage of sales continued to hold that 34 to 35% sort of mark, and we had a net profit which saw a marginal growth year on year. What's good is that the underlying volume growth has come in at 10.5%. There has been a 200 basis points impact on sunscreen due to unseasonal rain. So if you add that back, the revenue growth would also be near double digits. The margins, while declined year on year, there has been a sequential improvement telling you that trend may continue as well. There's a near 264 basis points improvement quarter on quarter. And focus categories, there are 7 categories in which the company is focusing on, which accounts for 80% of their sales. They've shown a double-digit growth already. And in the conference call, the management said that they aspire high teens growth in focus categories. And for FY26, they will expect margins, at 7% with 100 to 150 basis points improvement every year thereafter. Brokerages, they're positive as well. CLSA has written, on the stock, they've upgraded the stock to outperform a target price of 333. Jefferies, too, has upped their EBITDA estimates basis this beat by about 3 to 11%, and they have a target of 400. They say it's a high-risk, high-reward play, and currently it's high reward.
Thank you very much for that. The other big mover is Premier Explosive, exploding in trade, 14% up. Ria joins in.
Well, yes, Premier Explosives has been trading higher in today's session after reporting a very strong set of numbers in quarter one of FY26. Revenue up nearly 72% compared to the previous year. EBITDA has also gained around 35%, but remember the margins have contracted by around 400 basis points in this quarter. Net profit has more than doubled to rupees 15 crores this time around. The material cost to sales has also jumped significantly to about 66% versus about 41%. However, other expenses have dropped to around 9 crores versus about 18 crores in Q1 of FY25. Coming to the order book performance has also been very strong, up over 32% compared to rupees 750 crores at the end of FY25. Right now it's at about rupees 988 odd crores, with defense contributing the most to the order book at around 87% of contribution. And apart from this, the company has also approved a fundraise of rupees 300 crores. So all of these factors are leading to the gain in today's stock of over 14%.
Okay, that's a big move, right? Ria, thank you very much for that. I just want to quickly make a mention of Shakti Pumps. I mean, it was a big start. The high today was about 899. It's cooled off. I mean, just 3% left now. 862 or so after the big gap up that we had in that one. Commodities in focus now. Manisha is here with what's top of mind for her. Manisha, good morning.
Morning, and thank you for that, Prashant. I'm looking at the crude oil prices because we've seen constant declines into this one. Previous week was 4.5% of a decline, and we are trading in the negative in the Asian markets right now as well. So with that, it's trading at a 2-month lows. Various factors really which are weighing onto the markets. To begin with, it is about the US crude inventories, which have risen by 1.52 million barrels. This is as per the API data, which is weighing onto the markets. The second point really is the EIA numbers, which say that the US crude oil output will peak at record 13.4 million barrels per day in 2025, and 2026 the output is going to be lower than these numbers. The other point is from the OPEC report, which says that they are leaving the demand unchanged, but 2026 they expect the demand to gain up anywhere between 1 to 1.4 million barrels per day. The markets also are looking at the US Department of Energy, which also says that in 2025 the global surplus is estimated at around 1.7 million barrels per day. So clearly we are looking at higher production, higher inventories and a surplus as well. And then you also have optimism around the US and Russia meeting, which is on 15th of August. In the meanwhile, while there are not going to be any sanctions on Russia, we already have seen US imposing higher tariffs on buyers of Russian oil. That is something that the markets hopes will perhaps be corrected going forward. But quickly, I also want to share the outlook for crude oil prices now for the rest of 2025. A lot of reiteration and some revisions as well have happened here. UBS talks about 62. Remember, we're trading at around $66 to $67 a barrel right now. Not too many banks and brokerages believe that the crude oil prices will gain on from here on. most of them expect this year to end on a lower note. So $62 a barrel coming in from UBS. Goldman Sachs has talked about 66 on average. JP Morgan talks about 60 by the time it's ending this year. Morgan Stanley is talking about 62.5. ETO market says that 55 to 75, a $20 offer range, is something that's becoming a norm now in sense of crude oil prices in a matter of 6 months. And you could be looking at prices moving within that range.
All right, Manisha, thank you very much for that. Commodities in focus there. We're going to take a quick commercial break here. On the other side, our special segment, Market Masters. Latha in conversation with Ashish Gupta of Axis AMC and stocks, banks, bonds, and more. Stay tuned.
Welcome back. This is Market Masters, actually not so much economy, because the earnings season is drawing to a close and the Nifty is trading at barely a 5% growth in first quarter EPS. Year on year, it's flat. Just 2% year on year rise in the Nifty index itself. With tariff headwinds still very strong, how is the earnings picture going to look for the rest of the year? And of course, the market picture. Bond markets have actually done worse. Despite massive rate cuts, and the 10-year yield is actually 0.25% higher than it was in early June. So therefore, what are the prospects for both fixed income and for equity markets? We have with us Ashish Gupta, the Chief Investment Officer at Axis AMC. Ashish, good morning and thank you very much for joining us. Ashish is also a master of the F&O market. He's also a very keen observer of the banking system. So time permitting, all those questions. But Ashish, first up, the earnings season is almost ending. Maybe one or two results to come. What's the sense? How has the season itself been? And what are the next 3 quarters looking like?
Oh, I think the earnings season has kind of somehow reiterated the trends we saw last couple of quarters. I think earnings have not disappointed too much, but the overall growth continues to be lackluster. It continues to be in the single digit. And actually, more than the earnings per se, I am actually also tracking what is happening on the top line. And actually, if you see the top line growth that we continue to deliver is only around 6-7% for the broader market. Of course, in some sectors, in some mid cap and small cap cohorts, you are getting still between 10 to 12% top line growth. But for the larger cohorts, you are actually continuing to see top line growth continue to stay at about 6-7%. I think this is reflective of what's happening in the economy as well. And I think one thing we underappreciate is that we actually live in the world of nominal GDP rather than real GDP, right? And while we focus on the real GDP numbers, actually now consistently for the last 4 years, we have been seeing a drop in nominal GDP, and that's kind of weighing on corporate earnings as well. And I think this is what's reflective. The slowdown in nominal GDP is reflected in your GST collections. They are, as you know, also down to about 6-7% growth. And I think the trend is quite clear. Right? So post-pandemic, I think FY22, we had almost a 20% nominal GDP. Right? Of course, we were coming from a low. And since then, we have consistently seen a drop in nominal GDP. Right, so from 20% growth in FY22, I think next year was about 15%.
Yes.
The following year was around 12%. Then last year we were sub 10%, and I think this year, or at least currently, we are probably around 8% or so. And I think that is something that is going to weigh on corporate earnings.
Okay. Well, just for those who don't like this kind of jargon, nominal GDP and real GDP. Real GDP is the actual amount of goods and services that the country produces more than last year. But then you have to add a price rise, then you get nominal GDP. The point is the price rise has not been much. Actually, wholesale price index has been negative year on year. That's why Ashish is complaining. The nominal GDP has been bad. Actually, the number that will come out on August 31st for the first quarter, we may see a huge convergence of nominal and real GDP. Okay, I take your point on that, Ashish, but the useful point in the result season has been the performance of the mid-cap segment. We have seen some standout performance. I'll just read out from a report I have, and I'm reading EPS, earnings, yes, not top line, as you say. See, cement is up 35%, obviously because of base reasons as well. EMS, up about 46%, logistics 20%, healthcare about 11%, real estate again 40%. So do you think that we are looking at the wrong place? We are all used to looking at the Nifty and the the big stocks. Will mid-cap deliver as good and better for FY26?
So I think there's no doubt that there are certain pockets, and actually it's some of those pockets are reflected even in the large cap, maybe not in the Nifty, but if in the Nifty next 50, where instead of single-digit top-line growth, you are getting double-digit top-line growth. So if you see that cohort, you are getting instead of 6-7% top-line growth, about 11-12% top-line growth. And in some of the sectors, like you mentioned, cement, real estate, hospitality, you are actually continuing to see a 20% plus kind of earnings growth. What we also have to keep in mind is that expectations are also similarly high for those sets of companies and those industries, right? And if you look at the average multiples that these companies are trading at, that's literally at a 60-70% premium to what the Nifty is trading at. So I think, yes, some of these have delivered. And actually, the good news is that we have not seen an increase in the misses in earnings. So what first quarter delivered both for the Nifty companies as well as the broader set of companies was largely in line with expectations. But the fact is that for the broader market, we have seen only a single-digit earnings growth.
Okay. So therefore, if you can give us some forecast for the year, we have the tariff headwinds. Now, the best case scenario has become if we are back to 25%. You know, that 50% is such a complete embargo, as the Gokuldas exports gentleman pointed out. It's a no trade zone. So what is a working number? I know it's a difficult question because it's such a mercurial position we are dealing with. But what kind of earnings growth can we look at in the Nifty next, as you call it?
So I think we should not, at least for the earnings growth perspective and short-term earnings growth perspective, really focus too much on tariffs, right? So fortunately or unfortunately, we don't export much to the US, right? So our merchandise exports are only 2% of GDP. There is some carve-outs as well out of that. And on top of that, if you take out the piece of value add, so the impact on GDP will not be material. Of course, there will be some sectors and companies like textiles, as you mentioned, that may see a larger impact. But for larger corporate India, it will not be material. I think of course, it's a challenge for us because we were actually hoping that there will be a huge opportunity for us as a country to develop as an alternate manufacturing base, and some of those plans may come under cloud. But for earnings per se, I think what is more important is what's happening on the domestic economy. Given all the liquidity infusions that we have had and drop in interest rates, do we see a revival in domestic growth? Yes, and consumption has been weak. We have seen, fortunately now for 3 quarters,
Ashish, you know, I'm sorry, I'm going to interrupt because I'm going to pack in so many questions. So just tell me, what sectors will Axis AMC bet on in this mid-cap space where we have seen growth?
Sure. So we do like real estate. We are actually seeing on the real estate side, the commercial cycle actually continuing to strengthen. We like still capital goods space, and if you see earnings delivery among companies such as power equipment manufacturers continues to be very good. We like healthcare and hospitality, travel sector. So there are the whole host of sectors which continue to do well, and the growth rates here are significantly better. Similarly, on the consumption side, while aggregate consumption trends have not picked up still, but you actually still see market share gains for retailing companies. You see for quick commerce companies, consumer tech companies.
Yeah, take your point. All those, we were just discussing Nykaa numbers looking very good. So quick commerce, consumption, all doing well. Let me cut to a topic which I used to interview you frequently in your previous avatar. ICICI having this higher minimum balance. How do you look at it? You know, do you think that there is going to be an elite versus mass, classes versus masses kind of division in the banking sector itself?
I think the fact is that banks also have this challenge of providing high quality service, right? And I think both because of the customer's expectations, as well as the fact that the regulatory burden on the quality of service being provided is increasing. In fact, if you look at banks in India, the kind of services they provide for the fee, including real-time transfer, I think that is unparalleled anywhere. So I think in some senses, it is fair for banks to kind of look at cohort of customers where they can meet the customer's expectations and
Okay, I take your point on that, but I think I'll have to invite you for 3 separate discussions because I have 3 separate areas to ask you. Finally, leave us with what we should expect in the F&O space. There is some speculation that weekly will give way to fortnightly. Is that a solution to the somewhat recklessness that we saw in the weekly expiries?
So I think what SEBI has done is really act on 2 fronts, right? So one is on the regulatory side, and then it found some potential mispractices in the industry. So it has come out and used its supervisory powers to clamp down on some of the practices. I think there have been multiple regulatory actions taken between October and March, and some of them will continue to get implemented over the coming months. The good news is that we are seeing some tempering down in the volumes and activity in the F&O market. So my sense is SEBI will probably wait to see what is the impact of these measures. And if these measures don't prove effective, then it will come out with the next set of measures, right? But as of now, the first 2 set of measures are still being implemented, and at least directionally, it is showing an impact on the market.
Okay. Thank you very much, Ashish. That's some kind of hope for, the market intermediaries more than anyone else. BSE will be happy if it continues with that expiries. It's a money spinner for them. We have to wrap up on Bazaar, not because we're out of questions, we're out of time. Thank you very much for joining us. The market's actually surprisingly positive today. And let's hope it continues like that when Chartbusters comes up after the break.